Welcome back. This is Patrick Bartolotta, and I wanted to continue this series, this conversation on a variety of aspects of accounting and getting into just a very quick introduction to financial statements, which will then cover each of them in depth and touch on some accounting principles, specifically those that directly relate to what we're going to see on financial statements. So should be a short, quick one just to get this started here. The quick terms of accounting that kind of matter here is financial statements are what we're going to talk about. We have and they're going to come in the annual or quarterly reports. There's actually a host of other required financial filings or reports that companies have to do. But again, with the audience in mind of particularly those who are not accountants, it's worth understanding the two that we'll see in most cases: the annual report that they release once a year called a 10K, and a quarterly report released arguably 4 times a year, although the last one is usually just a part of the annual report, the final or fourth quarter. In those, both the quarterly and the annual report, we're going to see all 3 of the financial statements that I'm going to talk about. Technically, there are more than 3 financial statements, but the goal here is to focus on the 3 that are most common or useful, valuable to those who are still not accountants themselves or directly involved in a lot of the depth of this information. The income statement, also called the P&L, the balance sheet, the statement of position, it's also called the statement of cash flows. So we'll cover each of those in this particular topic in depth, and I'm going to walk through specific examples and give some comparisons across different companies. With that, it's worth noting a few accounting principles that relate specifically to financial statements, and I'll talk about these in order, and then actually we'll see them directly when we look at some financial statements in the future lessons. But the first one is the entity focus. When it comes to recording entries, but therefore also when it comes to seeing items on financial statements, we have to first identify what entity we're talking about. So I'm going to cover PepsiCo and Chipotle. And they're 2 different companies, and importantly, they're different from, their suppliers and their customers and all the other entities we could think about. So before we can do accounting, really, and certainly before we have financial statements, we have to identify and actually specifically name the entity we're talking about. So before we get into income statements, balance sheet, statement of cash flows, we have to know which company are we referring to. And that will be very clear. And I'll actually make sure that I have that on the top of each financial statement so we know what that is. The period concept, the general idea that financial statements are prepared over reasonable intervals. Technically, you could do them over any interval you want. It could be weekly, it could be monthly, etc. But what we're going to see, as I just in the last class, is the emphasis on the annual, which is what I'm going to cover with the quarterly reports, meaning the income statement and the statement of cash flows are going to be the performance for that period. So for the fiscal year 2022 or for the first quarter of 2023, something like that. So we actually identify the periods, and you'll see that there are dates on the financial statements, or something like for the 12 months ending December 31st, 2022. So we'll see that in action. I want to emphasize that we need to know the entity and we need to know the time period we're talking about. Monetary measurement. Items we're going to see are all going to be expressed in dollar amounts, and actually of a single currency as well. So we'll do both Chipotle and PepsiCo, and everything's going to be U.S. dollars. Their amounts are certainly going to differ, and the presentation is certainly going to differ, but they're not. These are 2 companies that have, operations outside the United States, but nevertheless still have, engage in transactions outside the U.S. So it's Pepsi certainly. They're going to have transactions that are in different currencies, but at the end of the day, the financial statements would be near impossible to use if it was each line item was itself in its own currency. So it's all reflected in one currency, and everything we're talking about we're going to see as a dollar amount. Going concern assumption. That is the assumption that the information we see and read and use in our financial statements is prepared with the idea that the company will stay in business for the next year, for the short foreseeable future. Meaning that the accounting is not prepared with a lens of like imminent bankruptcy. So if the company's going to go bankrupt in 4 to 6 weeks, and they know that, and they're going through that, we would do very different choices in accounting. Now, we're assuming that's not the case, right? We'll see Pepsi and Chipotle. Does that mean these are great investments? And I'm not saying they're bad investments either, but no, it doesn't mean that they'll last forever. It simply means that we don't have evidence right now that they're going to go under in the next couple of weeks or whatever. So we can make our assumptions and our amounts with assuming that you're going to stay in business. That does matter because you can make reasonable assumptions like the inventory that you're going to sell it. You're going to have to pay your liabilities, that kind of stuff. Some additional aspects are worth covering somewhat quickly. A huge thing when it comes to recording accounting amounts and transactions is going to be our clear emphasis on market-based transactions. And so when we're going to be recording things initially in many cases, and this is not really a deep dive into journal entries, we'll cover that later, but we do use market-based evidence in many cases when we record the initial transaction. That being said, there's other areas of accounting that include an inevitable use of estimates. So we don't just have like one way of determining accounting amounts. Sometimes we're going to use market-based transactions. Sometimes we're going to use estimates. Sometimes we're going to use the historical cost, which is usually actually the initial market-based transaction that stays at that amount even as time passes or as other changes might occur. So the items on financial statements are determined with different methods. That's okay. The reason why I want to emphasize that's okay is that not all assets and liabilities are identical. So as we cover different assets and liabilities, we'll discuss why and how they might be determined with different methods. And that's not a bad thing. That's just inevitable. It's not necessarily good either. It's just an inevitable reality that businesses are complex and layered. Matching principle in general, and not as a strict rule, we want to think about we can match our expenses on an income statement to the revenue we've generated or earned in that period. So that's a general idea to kind of think about, if we earn a certain amount of revenue, we want to be thinking which expenses are matched to that revenue we earned in that period. And then conservatism. Aspects of accounting may lean a little bit more towards conservatism, meaning we're trying to not overstate our assets or overstate our revenue. And we're trying to not understate our expenses or understate our liabilities. To be clear, there are specific aspects of accounting that include this idea of conservatism, but there is no blanket statement, expectation that accounting is by definition conservative. In many ways, you'd argue it's just neutral. It's not designed to be, but there are a few exceptions, moments when accounting is actually leaning towards being more conservative, meaning not being neutral. More inclined to make sure that we're not overstating things like assets or revenues, right? So we'll see them in action in our financial statements. I'm going to get into that real soon. Hopefully that's valuable for you as well. These are kind of tough just to cover as concepts. Well, you will absolutely see these in place when we cover our 3 financial statements: the income statement, the balance sheet, and the statement of cash flows. So one more down, 10,000 more to go. Take care.